want to thank everybody. It's 4:30. All of you know that I try and be punctual. If you've not been on this call, it is being live streamed as well. So we have attendees that are coming from, all over. And, when COVID hit, we started running a sort of a educational weekly chat. And really, we just continue to bring financial topics that's important to folks to help them to think about where they're at in their lives, what's important, and then what can we do to make sure that our plans are in place. Today I have a special guest with us, Victor Cale. Victor and I have known each other probably 15, 20 years now. It's been a while, and we've been friends, and we've he's a mortgage specialist, and not only mortgage specialist, but also an expert in reverse mortgages. Now, I don't sell reverse mortgages. I do understand them. And to me, all financial products are tools. And if they are used properly, they can actually be very beneficial should life happen. So what I'm going to do is I'm going to take us through some slides. This content is typically 15 to 30 minutes. I'm going to give Victor a chance to sort of ad lib as we go through the slides. He's not seen them. So as we ask the questions, and then from there, we'll just wrap it up and you'll have his contact information. If there's any thing in your future where you can use his services, he's been a great resource for us over the years, and so don't be a stranger. So without further ado, we'll get continued right down this information. His email, victor.cale@fairwaymc.com. And then you can see his cell phone number. He's very responsive. He'll get back to you. But he is New Jersey, so he's familiar with all the rules and things that are in New Jersey. So Victor, first thing, what is a reverse mortgage loan? And, high level, what has been your experiences if you were to summarize?
Yeah, well, thank you first, Chris, inviting me to be on the call. Reverse mortgage, anyone over 62 years of age who doesn't want to pay a mortgage. And then maybe someone is retired and still owes something on the house and doesn't have to pay a mortgage payment. Also, someone has a house free and clear, get a small reverse mortgage for the line of credit purposes. So that's many different options on reverse mortgage. It depends on a person's situation, but you can apply it different ways for sure.
Absolutely. So I'm going to take us through some bullets that I pulled. So if you're 62 or older, and I think it's called, HECM, a home equity conversion mortgage is what the government calls it. It allows you to convert part of the equity in your home into cash without having, to pay, to sell your home or to pay additional, if like you said, mentioned monthly bills. One of my understandings is you must have at least 50% equity. So it's not for everybody. If you turn around and let's say you have a house that's worth 400 and you owe 300, this is probably not a fit, right? But there are times when most people, especially as they start to, and I bring this up because I have a client right now who has I helped him retire at 65. He's 68 in 3 years. He left. He's single. He's got no mortgage. He's got more money than he'll ever need. And one of the things that, I have now gotten definitive proof of is he's starting to suffer from cognitive disorder. He's starting the onset of dementia. So, he's still functioning right now. He has all this money. So maybe this would be a tool for him where he could turn around and access because he's got no kids, he's not leaving New Jersey. So why not you leverage that house to have somebody come into their house, help them to pay for the costly expense? Care is not free. So the question then is, how do we pay for it? So those are one of the things that I observe. And then it enables the borrower to convert a portion of the home equity. And I think this is component key because, we at Professional Planning Services for years have been shouting from the rooftops how to generate and create and have part of your portfolio be income tax free. There's no required monthly principal and interest mortgage payments. And I think this is what confuses people, right? They're so accustomed to paying a bill because they had a mortgage, they don't like debt, and now they're like, wait a second, they hear the word mortgage, but instead of paying money, they're actually receiving money. And so once you understand that, and you can help them to look at their specifics, but that's usually an area where we get question marks. But this is also, there you must pay the property charges. Make sure that all things that are related to the property, like taxes, like insurance, those things are up to date in order to be able to be eligible. Would you agree with that?
Yeah, and also maintain the house. It's when it's like you gotta pay your taxes, your insurance, and maintain the house, you know.
Absolutely. So
And we do a little bit of underwriting. So if they don't qualify, depends on the person's situation. If they don't show that much income, you'll have to include the taxes and insurance into the reverse mortgage, which the client then doesn't pay anything, doesn't have to pay the tax on insurance. They have to still maintain the house. But for someone with like credit challenges, low income or this or that, as long as they have enough equity in the house, you can include it all in the reverse mortgage, so they don't have to pay the taxes and insurance too.
perfect. Hey, and so that sort of brings to a question. Let's just think, and again, I don't mean to put you on the spot if you don't know, but let's say that there's a couple, and the house is in both of their names, but one person is saying, "Hey, let's say that one person is 62 or 64, and the other one's a little bit younger. Maybe they're not eligible. Does that disqualify them if the person that is a co-owner of the house in any way?" Or maybe doesn't have credit, if as long as one person in the house, are they still eligible?
Yeah, they're still eligible. And again, it's all, depends on the age and the younger you are, the more equity you need in the house to be able to do a reverse mortgage,
Okay.
So the husband could be 62, 63, whatever, the spouse can be 58 or 55. That's fine. We can still do the loan. It's just you have to have a little more equity.
Okay. All right.
Which
Cool.
is like, yeah, you can't leave. It's always good because something happens to one spouse, the other one could stay in the house until they pass away. I mean, it's for many, many, many years to come.
Oh, and might be a good strategy as well. So then that you had mentioned to it, but what are some of the things that you found that people like you, we've already sort of touched on it and it may seem redundant. Like I said, Victor hasn't seen these slides before, so these are impromptu questions for him. But so what are things that you've seen or can you think of that people could use this for? You've already mentioned a couple, which is property taxes and insurance.
Yeah. So my latest one I did, this lady, she's the widow, she's 74 years old. Um, she had an annuity. The annuity is about to stop. And so she's been kind of struggling, and the house was paid off, you know. She had actually, no, I'm sorry, she had like a small $100,000 mortgage on the house, but the house came in at 800,000, but she was like struggling because she had a little bit of extra income that was not coming in, and she had three daughters, and the daughters contacted me. Um, so we did a reverse mortgage, and she's taking out, 4 or 5 thousand a month, and she could do that for many, many years. And she lives, comfortably. She go out to dinner. The daughter's like, my mom's not even going out to dinner or anything like that. She's living a very restrictive lifestyle. We want her to enjoy it, and we're able to do that. That's one we used. Another one, 68 years old, by herself, a lot of equity in the house. I guess the house was paid off, but she was working two jobs, and she really didn't want to work two jobs anymore. She had other things like the credit cards, this and that, other things, etc. So we basically took out the reverse mortgage. She paid off all her debt. And now she quit one of the jobs, and now she's working part-time, and she's enjoying retirement. She has
Well,
family in Tennessee, so she's going to Tennessee a lot more, and this and that. So, on a high level, there's other things that you can do for tax strategies, because you get a 1098 from your reverse mortgage at the end of the year to offset some of the income. There's a high level, tax strategy for somebody who's doing really well, has a lot of money in the market, and and has to take, the minimum from their 401k or something like that. So it goes from a big range, people that actually need it, people that don't need it, people that just get the reverse mortgage just for the line of credit, because the line of credit is going to grow no matter what every year, and you have access to that. And as long as you live in the house, that line of credit is never going to stop growing, and they're never going to close it. Meanwhile, if you get a mortgage at your local bank, a line of credit, local bank, if you use it first, you got to pay the mortgage, and they could cancel it at any time, like a lot of these banks do. And this reverse mortgage, that doesn't happen.
100%. And you mentioned something that prompted a thought with me is that, the three daughters for the lady were looking out for mom. And in my experience as a financial advisor, what I've learned, as people are amassing wealth, as they own a home, multiple properties, whatever, we have a sort of a saying within the industry: the kids don't want your house. Right. So at the end of the day, here we're thinking we raised our family here, we have our children here, and we're going to, the kids are going to inherit the house, but all they're going to do is sell it. And so then we're subject to market environment, right? So is the market up or down? But what you alluded to, which I think is a missing component for a lot of people, is that reverse mortgages, that line of credit is growing and growing. So if you're pulling money at some predetermined rate that it's growing, you could literally be upside down in the house at some point in the future. And guess what? That's the bank's problem, not your problem. So it's a way to transfer an asset to help people to utilize equity, which otherwise they might not ever be able to use. And again, I don't do mortgages, but I really do think that it's a tool that quite often I think is misunderstood. The other thing I wanted to say, Victor, is one of the people on the call, Tim Will, is a longtime client of mine, and you actually helped him and Lisa years ago with their mortgage. And he just sent me a private message, said, "Oh, I dealt with Victor years ago, and good guy." So anyway, he was saying hello, and I just wanted to share that. So again, paying off the mortgage, medical bills. Victor, this is what you were talking about: volatility buffer. So as a strategist, financial advisor, and dealing with people's money, and we're putting plans in place, sometimes we put on where our portfolio is supposed to throw off amount of yield or return, and we're living off that, or we're utilizing that into retirement. But then the markets happen, like yesterday, flash crash, right? 1,100 points down, right? Suppose you're drawing down, and all of a sudden you had to pull money out while the market's down. That is just a recipe for disaster. Having this as a tool, as a buffer, that's why I call it a buffer. Markets are down. Let your assets or your 401k, your IRAs still heal. While now you can pull money from the equity in your house until you get to a point where they recover, you can turn that then back on and start to pull money from your market or from your assets. So I wanted to point that out. Emergency capital, funds to pay. Again, I mentioned earlier, and then you as well, tax free. If we can, everybody now, I think everybody has heard that, hey, growing money tax free and Roth conversions. It needs to be done thoughtfully, and it needs to be done by somebody that understands what they're doing and how to do it, so that they don't end up, just in a shock when they get the tax bill. Our philosophy has always been Roth conversions, 9 times out of 10 will make sense. But the question always becomes, where does the money come from to pay the taxes on the conversion? Where's the money come from? If you don't have the money sitting in a brokerage account, if you don't have the money sitting in a CD or in a savings account, it never usually is efficient to raid the IRA or the 401k to pay the taxes from within that. We want to actually convert as large a sum to in Roth conversions, and we do these regularly. So having access to capital in the form of a reverse mortgage, and as I mentioned, the kids don't want your house anyway, can be a very strategic tool to help you to clean the taxes from your holdings over time. But it needs to be done strategically. And just another point I wanted to put out there: So you had mentioned this. So talk to me about this, how might this work if somebody wanted to pay off their existing mortgage? Give me some high level framework or experiences or examples that you've dealt with that have, I think you've already alluded to one, but go ahead and touch on that.
Like pay off with a reverse mortgage, somebody owes has
Yeah,
to pay
so
the
let's say you
mortgage.
got
Yeah.
a house worth 500 and you owe 100. How would that work?
Yeah, so you when we do the reverse mortgage, we would pay off whatever liens you have on the house. Sometimes people have two mortgages, a first and a second mortgage, you know. Um, so we would pay off and roll in all the closing costs, so they don't have to put anything out of pocket, as long as you have the equity there. As far as the equity, it's all about your age. So the older you are, the less equity you need to have for the reverse mortgage, because the reverse mortgage goes by technically life expectancy, like you would do on the life insurance, that they have some sort of, depending on your age, married, not married, a man or a woman, and they have this thing, they think how long people are going to live. So they do that, this amount of years, you need this amount, because they do the numbers that so that they're not upside down, basing on the value of the house, what they think, the projections they do, they think what the value of the house is going to be and all. But even if you get it upside down, doesn't matter. Like you mentioned before, you don't owe anything. You know, if they pass away, they're 95 years old, and the house is worth 1 million, but they owe like 1.2, the family, they could sell it at 95% of that value. So like 950,000. They have first option to buy that house at 950,000, even though the parents owe like 1.2 million, even if like, even like sometimes people with that line of credit goes much higher than what the house is worth. They could take out that line of credit, that take out that money, and you'd be upside down. Something happens to them, nobody owes anything, that's
So you
part of
could
the
stroke
mortgage.
a check, pull the equity out if you, and high level example. So in your example, you turn around and you had this equity, you didn't really tap into it, but that the parents or the reverse mortgage holder is, let's just say, in hospice, right? Or maybe they know they've been diagnosed terminally ill. They could literally stroke a check, right? Deposit the money some way, strategically. I know the rules and can show you how to do that. And even though that the house might only be valued at 500 or 1 million in your example, but you pulled out 1.5 and pocketed that, to me makes a lot of sense as well. It's almost like having a crystal ball, and you're able to take advantage of should life happen. So very good. And I just want to, so paying off a mortgage is the American dream, but one option might be allow the equity in the house to repay the remaining note. Using home equity will reduce assets transferring to heirs. So that's just something that, from a disclosure standpoint. And then Gene just brought up, because this is one of the questions that I've heard over the years, and it's a fair question. I've heard that reverse mortgages are expensive, right? Or that they're and nobody can invest for free. I mean, banks are not in business to be missionaries, right? They might be mission minded, but they don't work for free. And I don't begrudge anybody for making money, but when you look at it and we say you have an asset. So let's take my example of my 68-year-old single male, has no kids, has no mortgage, has an asset where we are in I mean, I think very high real estate values currently, maybe not as high as they were, but we are still at elevated. So there's equity there that's not being utilized, that has not been tapped into, and so there's a cost to get it. So whatever that expense is, and roughly, is there a rule of thumb that you say, hey, roughly all in it's about X? Do you know that number?
Yeah, I mean, yeah, the closing costs on reverse mortgage a little bit higher than a regular mortgage, not much. The rule of thumb is like, okay, I'm going to get a reverse mortgage, and next year I'm going to sell the house and move to Florida. Don't do it.
Don't do it.
So if you're going to be in a house like 2+ years, yes, but the longer you're going to be in the house, the better it is, the cheaper it becomes, basically, But yeah, I mean, more, depends on if there's anything owed on a house or not. It could be 15, $20,000 for a closing on a reverse mortgage. But that's these days on a regular mortgage, that's what it is too. With the home prices the way they are, I see it all the time, so technically, in reverse mortgages, closing costs haven't really moved, haven't really changed.
So
But
it's still correlated to about what a typical mortgage would be. So,
correct, correct,
whatever that
correct.
mortgage is, so it's just another way. So that was a great question, Gene, and thank you. Paying medical bills. So, have you run across anybody? I mean, I have designation, certified long-term care specialist. I am seeing the cost of care. I've had clients firsthand. I've talked about them on these calls before. Medical expenses are the one thing. I don't care how much money you have, and I don't care how well of a plan that I've designed for you. It is the one area that can absolutely upend the apple cart for somebody's planning, especially if you're married, right? Because here you're turning around, and it's what I call care span, where somebody, I'll always share this, Victor, is that, is my wife going to take care of me if I become ill? Of course she will, right? I mean, women typically are caretakers. They're going to take care of the spouse. But I weigh 220 pounds, right? I'm a lighter than I was, but I'm still heavy. My wife is 115 pounds soaking wet. So how many times could she take and get me in and out of bed, right? So having a resource so that she doesn't necessarily have to be the caretaker, medical bills, things coming in that she's not stressed. It could be this sort of safety net that allow them to pay for expenses, to pay for custodial care, to pay for medical equipment or anything that's unexpected. Would you agree with that, or did I miss something there?
Yeah, you could definitely do that for sure. I had an example, reverse market a year and a half ago, like in the beginning of the summer of 2023. She was 80 years old. Her husband had passed away like 20 years ago. And then all of a sudden she became sick, and she had to on dialysis like 2 or 3 times a week. And she had a house paid off, and worth about 500,000. And like the daughter wanted to put her in a home. She didn't want to. She's like, I know, like, so we did a reverse mortgage, and she had medical bills and all that. So she didn't really qualify. She didn't have much income at all, just Social Security and very little. So we had a reverse mortgage, which we included the tax and insurance and everything in the mortgage. And we also paid off all her bills, and she was taking money out every month for the expenses, because she had a caretaker coming to the house every day, so that was expensive, but she felt comfortable at home. Um, she passed away 6 months after, but she was, less, she told me, because I sat down at the kitchen table with her, and her brother's trying to help her out, and her daughter was there, but the daughter, financially, they couldn't really help her, so she had to rely on the reverse mortgage for the last few months of her life. She was much more comfortable at home, where she felt comfortable, because
A
she had
hundred
been in the
percent.
hospital for like a month, so it's like a sad story, but she was so happy to be at home. She definitely didn't want to be out of the house.
And that's been our finding as well as what we've learned over the years is that when we ask folks, if you had a choice, where would you want to be cared for, right? Nobody wants to go to a nursing home. They're depressing. It's where we typically think of we're going to go to die. So if we're comfortable in our house, if we can somehow arrange, this end of life to coordinate that, I think it just makes a lot of sense. So no one wants to pay large medical bills, but having access to your equity, this is where planning with the end in mind, having a tool in place. We don't know what life's going to happen. You don't have to use it, but having that in place will give you peace of mind. And then using home equity will reduce assets transferring to heirs. So the volatility buffer, I've already talked about this a little bit. So we're just going to access to emergency capital, right? Again, nobody, I just sort of coin phrases, but expect the unexpected. Life happens, right? Nobody expects a need for the roof to go, the boiler to go, the driveway to need repair. I just got my property taxes reassessed. I'm appealing them, but these are all things that happen in life, right? So having types of emergencies will happen. I think this is a key point, I've asked this question to folks before. It's always whether it be college planning or when I'm talking to folks, when is the time to look for a job? and I pause and I wait. And finally, usually somebody will say, when you have a job. And I go, very good. So if that logic makes sense, then the next logical question is, when is the time to look for money? And the answer is before you need it. If you wait until you need the money, it could very well be too late because banks do not lend money to people that need money. The first thing they're going to do is say, do you qualify? And if you don't qualify, you could be SOL. So, that was the point of this slide. So again, these were all important. And then I talked about the Roth conversion taxes. This is Victor. I want to thank you for your time today. Very well done. Take a screenshot. There's his phone numbers, office numbers, email. Victor, like you said, we just heard from Tim Will, who you've worked with in the past. A personal endorsement from one of my clients who recognized you and said, "Hey, great guy." So, we're very proud of our relationships with advisors over the years. Victor's happy to help you. There's no obligation. At least just see what your options are. And then, again, we'd like to have you back again in 2025. And I know, you've helped many of my clients out over the year. The last thing I would want to just make sure, I am not afraid to say it. I'm old school. To every single one of you, from my family to everybody on this call, very Merry Christmas. Whether you celebrate it or not, I wanted to just wish everybody the blessings from our family to yours. Victor, to you and your family, Merry Christmas. To everybody on this call, thank you for taking time out. This is our last call of the year. We will start back up in the first week, I think the week of the 6th. We will have probably we have some topics. Somebody just put through into chat there. Merry Christmas. Thank you, Tim. So everybody, I want to thank you. And then this is our disclosure. We'll go ahead and we'll end with this.